Welcome to Market Monday from the investment team in the trust department at the First National Bank. We'll start today like we usually do with a review of everything that's coming up in the next couple of weeks with regard to economic reporting. Now, with that said, in the current environment, these reports take on a somewhat reduced importance as drivers for, equity and rates markets returns because we've got such massive geopolitical events going on overseas. We have a hot conflict in the Persian Gulf that's driving energy prices higher. There's our other catalyst. There's the conflict itself. There's the energy prices. And then there's the decay at a minimum and potential complete breakdown in a piecewise fashion of well-established, long-standing institutions. And I'm talking about NATO and I'm talking about the United Nations in terms of their importance becoming greatly reduced in light of recent events. So as we're looking at these things, which imply, somewhat of a break in the established world order and the creation stage of a new one, as trade blocs that are formed recently learn to relate with one another, those things have taken on a very much increased importance as far as driving markets. Looking at what we have on the docket, we just got the services index. That's a sentiment report. We have durable goods orders tomorrow. That's demand conditions. We get the Fed meeting minutes later in the week. We get information about inflation. The Fed likes to use this core PCE, which stands for Personal Consumption Expenditures Index. They really like to use that as a gauge of what's happening structurally with inflation. And that number is problematic for the consumer to look at and gauge inflation, because inside of any core number, core being put in quotation marks, you have stripped out the prices of so-called volatile goods, energy and food in particular. So while this is great to get an idea of what the overall bigger picture is in inflation without all the blips, food prices and gas prices and so forth moving pretty rapidly and all over the place on any month-to-month measurement, this isn't reality for the consumer. For the consumer, they're looking at this, the CPI, period. And when we get that March number, that's expected to come up an entire percentage point on the year-over-year basis for inflation as of March. And that hasn't even taken into account the real spike in gas prices, which we've experienced just in the last week or two. We expect that number to come in a little bit hotter than what this consensus is at 3.4. And ultimately, for a consumer, this is the number you got to be looking at, because you are buying food, you are buying gas, and you are impacted by these higher prices, whereas the Fed in making policy can't really take that into account. Therefore, you see a mismatch between what's being said by the Federal Reserve and what you're experiencing in the grocery store or at the pump. That's basically the source of the mismatch. It's a matter of point of view and what time frame you're looking at things. Looking into demand conditions, we'll get information later. And this producer price index, the PPI, this is interesting too, because when you take the consumer price index up here, that's how fast essentially companies are raising their prices and consumers are buying. That functions as a proxy of the ability of a company to price its sales. And the producer price index can function as a proxy for the input costs. So in other words, if the consumer price index is rising at the same rate that the producer one is, you have stable corporate margins. Translated into English, that means a company makes the same amount, or maybe even more if that relationship's favorable, the same amount of money per widget sold. And that is good for profits. So we want to see the producer price index rising either slower or at least at pace with the consumer one. If that flips and producer prices are going up by more than the consumer prices, that would imply that companies are making less money per widget sold, and that's bad for stocks. So we watch that relationship as a proxy, kind of a forecasting tool for what's going to be the next earnings season, what are the conditions that companies are operating under. And we'll look at the leading index, some other stuff, labor market information, but again, the stuff's kind of reduced in importance. And I want to point something out. This average estimate of about 3.4% for the next CPI number, that's a big jump in inflation. And when consumers are paying this at the pump, and they're paying this in the grocery store, they're feeling it, and they're resetting their longer term inflation expectations and changing their buying behavior. That's overall bad. That sets the stage for this inflation to become structural. When people start to change their expectations for the longer term and adjust to a more inflationary environment, which we are indubitably in on a secular basis, in other words, a long-term basis, that means it's going to be harder for inflation to be put under control, and the Fed doesn't have much in the way of policy tools to do that due to what we consider to be incorrect application of monetary policy at times during recent years that now leave us in a position where if there is an economic slowdown and we get a recession, they're not able to lower rates as aggressively or maybe even at all because, inflation is going to be running too hot for them to do that. And they're only making things worse. The last time we saw a period like this was in the 1970s. And this is what inflation looked like in the 1970s. Now, you may take issue with this analogy, but let's look at the facts. What's happening here? Push aside what we're being told by the authorities, whoever they are, whether it's the Fed or whether it's the Pentagon or any of this. The last time in this decade was when we had a major energy supply shock. And we also had a competitive stage similar to the one we're in. I would say this period of the 70s is not even as extreme from the geopolitical standpoint because we at least still had a cohesive United Nations. We had a cohesive NATO during the 70s period, which we don't think is structurally sound anymore. But looking at this, we entered the 70s with inflation at 6%, the CPI, spiked up in 74 to 12.3%, spiked up again in 79, 80 to 15% before Paul Volcker came in here and said, we're going to beat inflation, we're going to break its back, something to that effect. He was the Fed chairman back then, an intellectual giant, actually. This was a very painful recession, a very painful period, but it did bring inflation under control. And then, coincidentally afterwards, we had this long period of globalization, and globalization and cooperation are disinflationary. When everyone can kind of specialize in what they want to do, what they're good at on a national level, and then expect free trade, you have Adam Smith's division of labor happening at the geopolitical level, and it's just much more efficient, and efficiency leads to lower prices. So we had that arise. We had just-in-time inventory arise to make the costs of holding inventory come down. And that was okay in a globalized economy because, if you only had on hand enough supply for a week and you knew that you could freely order, no big deal. Now, let's look at what's factually happened here, not what's been said. We have trade barriers and tariffs. We have hostility between parts of Europe and the United States. We have hostility directly with the Iran, China-Russia axis. We have some interesting new relationships developing in the Persian Gulf since Iran has gone and attacked its neighbors. But we have a profoundly different world than the cooperative one that most of our lifetimes has been the foundation of. So what we're looking at now is there are individual trade blocks that are all competitive with one another. They're competing for resources. They have to have completely internalized supply chains. And you're going to see a return to actually longer-term inventory, which is costlier, all of which translates to a structurally higher and volatile inflation period for us until these things get resolved, and they may not get resolved in our lifetime. This was not a change that is easy to go back from. We think that the structural fracture between Europe and the United States is relatively permanent at this point. We think that the structural fracture, around the world into different competing trade blocs is going to be the new structure going forward. Where that leads us, we don't know, but certainly it's a higher cost environment because everyone has to go it alone. Getting that out of the way, well, one final point on this matter. I made some pretty strong comments about the United Nations and NATO losing their teeth, so to speak, and they have. We're doing things and saying things, and our allies are doing things and saying things that suggest the United Nations has lost any kind of real influence. And in fact, their Secretary General came out a few months ago and said that if funding isn't, topped off by July, the institution's going to start running out of money. We don't know that it's a going concern in the same level of influence that it's had, again, for most of our lifetimes. We think that its power has waned, and it no longer really has much clout. I don't think that it's going to just be fractured and formally dissolved, but we also see there's a real defanging of that institution having gone on. Same thing with NATO. That may not collapse, but it may. There's been a lot of hostility and some heated exchanges between NATO members, and that alliance is also looking relatively ineffective. So these foundations that we've all known our lives have changed. The world is going to adapt to something else. Don't get me wrong, but it is going to be something else. We are not going back to the good old days. What does it mean for markets? Well, this is the past year, and S&P 500. We don't really want to see this pattern. There's an old adage: the trend is your friend till it bends at the end, and this looks pretty bendy. Not that we're chartists, but what this suggests is, market prices have reached a ceiling and gradually pulled back. They need a catalyst to go higher. And right now there's so much uncertainty and a lot of potential negatives that no one wants to take a position. That's the tail of this tape, so to speak. Volatility expectations as measured by the quote-unquote VIX index, which stands for Volatility Index, catchy. It's up at almost 25. And a VIX above 20 suggests that the market is in an elevated alert state. Anything above 30 is pretty much a panic state. So we're watching this pretty carefully, but right now the market is nervous but contained. Kind of what we wanted to see. Let's talk about energy prices. This is really interesting. So this is the Brent crude contract, which much of the world uses Brent crude as opposed to our West Texas intermediate, which we'll look at here in a moment. But Brent crude trading at 109.5, for a barrel, and our West Texas intermediary is at 112.5. We'll call that. Now, this is a big change from the norm. Normally, the Brent crude is higher for a variety of reasons: insurance costs, risk, and just supply, and the currencies that have to go into buying it and demand globally. This is a more expensive contract historically. If you look back to where we entered the year, Brent crude was at 60. You go back where we entered the year here, we were at 57-ish, 55, 57. Now we're at 112.5 here in the States, and Brent is at 110, we'll call that 109.5. That suggests that the relationship between international oil flows and domestic ones is potentially changing. And we haven't figured out what that portends yet. We're going to be doing some research on that. But it's a pretty unusual situation for this Brent to be lower priced than our West Texas Intermediate. What's happening in rates? Well, this is the government treasury yield curve. And we entered in, basically, this is showing the difference over the past month. Let's do something a little more interesting. And let's look at it since the day the war began. Well, that's the corporate yield curve, sorry. This is the government yield curve since the day the war began. And you can see that in the intervening period, large increases, up to about a half a point at the 3-year mark, have happened across the yield curve, except for this short term, which is linked pretty tightly to the Fed funds rate. Now, looking at this, there's only one input when bond yields are priced, and that is inflation risk, and the way market participants see that, what their number is, which is why the yield curve is a good indicator of where inflation is. It's tied intimately to it in its valuation. And the fact that this is up so much, these are big moves, by the way, 0.5 percentage point. That suggests that inflation expectations not only are elevated in the short term, but across the entire curve, suggests that the most sophisticated of investors, which are the bond investors for various reasons, the largest as well, that suggests a relatively permanent reset in long-term inflation expectations among that sophisticated group of investors. Going to the corporate yield curve, this is priced on two different things. One is the inflation risk premium that government bonds are priced on. The other one is a default risk premium in case the corporation is unable to pay its debts. And in this case, this shifting up in this manner kind of suggests that that risk is increased as well, and most likely, again, as a result of the more inflationary conditions expected, the trade barriers that are in place that are going to make it more difficult for companies to operate and so forth. In this environment, for the foreseeable future, companies really have to execute in their finance teams. They have to execute in their supply chains and minimize costs and maximize profits. It's just a tougher playing field. Does that mean we need to run for the hills, even though we're seeing this bendy pattern? This is a long-term chart of the S&P that I'll close on. No. Here we had, this is the past 20 years, here we had the great financial crisis of 2007, 2008, where our entire system was in danger of completely breaking. And it did not. We held out. We got through some crazy things in the teens. There were problems in Europe structurally. We had several. This 2018 here was notable as the worst December in market history. People got really scared. The market just fell out and bottomed on the 23rd of December that year, right when people were just giving up in panic. And that's how it always happens, folks. You're giving up in a panic, and generally that marks the bottom. This was 2020. The whole world shut down right here. And then we recovered and came back. We had a bear market in 2022. We had a bad market last year. We're not trying to bum you out with this. What we're saying is that despite all of the fear, despite all of the negativity in the news, despite all of the really kind of frightening, if we're being honest, changes that are happening at the global level, markets will persist. And what we need is, instead of emotion on this, we need a good disciplined plan, and we need to adhere to it. And if you do that, things work out. If you get scared out of a position, it's going to be at the worst time. And that's my main point. We don't want you to do that. If you've got questions about your portfolio, if you've got questions about the implications for your portfolio of current events, if you want to talk about anything like that, feel free to reach out to us. We love to discuss it. Hope you found the video helpful. Thanks, and have a great day.